Welcome to the Behind the Curtain podcast, your real-world guide to real estate investment and property management.
Whether you are new to real estate investing or you're a seasoned investor, it's likely that you've heard the predictions of a looming housing crash. In this episode, Brett and Aaron discuss the likelihood of a housing crash, and they present some other factors that other industry experts have potentially overlooked.
Housing crash. Number one, Richard said expert. There's no housing a real estate expert. In order to be an expert, you've got to be able to tell me tomorrow what's going to happen. Just like a doctor who's an expert heart surgeon can tell me the symptoms, the problem, and how to correct it. So experts are doing the same thing we do. They're giving their opinion based on what they see in the market. While I hear people talk about a crash, yes, I've said many times, this time next year, we're going to see a dip. We're going to see a slowdown, maybe 5, 8, 10%. But these guys that are running around talking about a 2008 all over again, where the housing market is going to just collapse and you'll be able to buy houses for pennies on a dollar and people will be homeless. And we're not heading that direction. And that's what I get a little aggravated when I hear these so-called experts talk about the crash, because what they're doing is they're actually taking people that would be investing today and people that should be investing today and causing them to doubt and to sit and to wait. And then what ends up happening is it doesn't happen and you're now paying more for a property than you could have this year. So here's my theory. Come January, we're still going to be rocking and rolling. I think things will have leveled off, cooled off. Maybe you can get some stuff a little under market. It'll be more of a buyer's market. As we get into April, it's going to pick back up again, and it's going to kick right into insanity, where we're buying stuff at $8,000, $10,000, $12,000 over asking. So if you're going to be an investor, do your investing between October and April 1st. Buy then, and then as soon as the summer craziness hits, take whatever cash you got left, put it in the bank, and sit and wait. Just take your time and take it easy. Because as we get through next summer and a lot of these current policies begin to take place and inflation hits that record high and ends up creating a small recession, and we start getting into harder times and companies start downsizing and people are losing their jobs, yes, we're going to have a housing issue, but it's not going to be a crash. It's going to be a correction. It's going to be getting us back to the days of sanity of 2017 and 2018, when a house sat on the market for a week before you had offers on it and you didn't pay way over asking. So my opinion is there is no crash coming. There's a correction coming, and that's going to be this time next year. And if you're long-term hold investors, who cares? You lose 5%, you lose 10%, next year you gain 15%. Who cares about the correction? We are not headed for a crash. Now, I didn't see COVID coming, nor did I see Joe Biden getting elected, so I could be wrong.
That's good. That's good. You know, Brett, obviously you and I have read several articles that oppose the notion of a housing crash. You know, so for our listeners, we're not just shooting from the hip here. Like we read every day. Right. You know, articles from, I've talked earlier about, I'm going to have to look this up and verify this. It's either Housing Wire or HomeWire.com. Right. I like them a lot. I like Market Watch.
Well, there's a lot of good articles you can read. And if you read into the information they're giving you, you don't have to be a real estate genius to realize we're not headed for some Niagara Falls type of real estate crash. Right. We're heading for, a little bit of a rapids that we haven't seen in a while. And it's going to be a little bumpy, and there's going to be a little dip in the market here, and things will. And places like California are going to get crushed. California, they will see a housing crisis like they haven't seen since 2008 because their bubble. Nashville is headed for a housing crisis. If you look at the places where homes are selling for $200, $300, $400 a square foot, there's where your housing crises are going to happen, because those homes are way overinflated. People are way over mortgaged. And when the economy begins to dip and the value drops, the first people to sell are those folks because they get scared.
Yeah, let me give a quick statistic on that. So this is some information I got late last week, that wages and salaries of all civilian workers, which are defined as workers in the private sector, along with workers for state and local governments, but not federal workers. All right, so that was a lot of words. But the point that I'm making is those wages increased 3.2% on a year-over-year basis since June of last year. Inflation, as measured by the CPI, which is the Consumer Price Index, was up 5.4% over the same 12-month period. There's a couple of other statistics that we could talk about.
And that gap's only going to widen.
That's exactly right.
And as that gap widens, people become less able to pay. And I'm going to clarify my statement.
It is a matter of affordability.
Correct. Let me clarify my statement. I wasn't saying that rich people are going to be in financial crisis.
Sure.
All right. What I'm talking about is you take a state like California and take Nashville. You can take a home out of Raleigh that you paid $80,000 for, drop it right outside of LA in California, and that house, it costs you $350,000
or more.
That same person buying that house, and the only reason why I say that is I have a lot of investors that come from California. And they show up, and they're not wealthy people. They live in a little 3-bedroom, 1-bath in California, and they happen to sell one of their homes for $500,000 and then come here and invest it. They're not rich. They live paycheck to paycheck. But they realize I can get rid of this $500,000 home and go buy 5-6 rental properties in Memphis and make $3 or $4 grand a month. I guess my point I'm getting back to, I need to get back to it, is that California, the affordability issue of the average person, as soon as the market changes and unemployment goes up, inflation goes up, that's who's going to get hit. All these policies that are in place are not for let's tax the rich. It's basically going to hurt the guy that gets up and goes to work and works 10-hour days, 6 days a week and lives in a little 3-1 out, somewhere in California or out on the outskirts of Nashville. Right now you go buy a 3-1 over there and it's $200,000, $300,000, $400,000.
Right. There are some other factors that are here that are going to play a part in the localized housing correction. So I think that's what we both agree on. There are going to be localized housing value corrections.
And Memphis won't be hit as hard.
Nearly as hard. And so here's a cool distinction. One is Southern California is the world's 7th or 8th largest economy as compared to world governments. We're talking about, you know what I'm saying? So we know at least we hear, and I think statistics prove that there is a mass exodus out of Southern California. Okay. They're moving to Texas, Oregon, all the western states. Tennessee.
We've had quite a few show up here.
We have. And please come. We encourage, and please raise the intelligence quotient of our state. We love working with Californians. We love your vision. So, but the point that I'm making is this. The localized correction is going to be on changes specific to that region, right? And that geographic location. They're going to have a governor change here very soon. Don't know where that's headed. They may have a change in their labor market, right? They may have a change in the jobs that are being hosted there. One of the things that I hear from Southern Californians more than any other population is this. Well, thanks to COVID, I can work from anywhere. So there have been a ton of people up until COVID, up until the Zoom boom, right? And the remote meeting boom and all that stuff, who were required to live in Southern California. That's changing. And that effect is going to have a long-term effect on the value of California housing. And we haven't even seen the beginning of that yet. So the cool thing about Memphis, though, just to bring it back here locally, is that Memphis is full of people who are in the service industry. In other words, I make my money serving people that live in my same city, right? And they make their money serving me. Yeah. And so we have a community of people who drive work trucks every day and, offer online services and all of these things. And so Memphis actually has quite a robust service economy. Sure. That's what's going to keep us going. And those needs and those services aren't going to change because of a massive change in the economy. Correct. I still need to go to the dry cleaner. I still need to go to the grocery store. I still need my plumber to come out and repair my, whatever. So we love Memphis. That's one of the reasons why Brett is still here. Listener, please understand, Brett could work anywhere in the United United States and make money. But there's a great opportunity here in Memphis for him to do what he does very well, which is to connect investors with property that they can say, I'm so glad I purchased that in 5, 10, 15 years when they consider what they're going to do next with it. It's a very, very vibrant marketplace.
And I've been in real estate in quite a few areas, predominantly in Louisiana, where I did development and buying and selling. And it is one of the unique things about Memphis, which is why I've been here as long as I have after I moved up, was because of the uniqueness of the market. And yeah, I could go anywhere and make money. I could go anywhere and develop a subdivision. But I tell myself and other people all the time that, I get asked all the time, are you ever going to move back home? I'm like, man, probably not. If I decide to, I can't right now because Memphis is where it's at. I mean, the ability I have here and the amount of volume and work that I have here due to the makeup and the economy of Memphis and its people, the people that live here, is unmatched anywhere else. I haven't seen that kind of opportunity anywhere else. So I've built my business here.
Yeah. To quote one of our favorite investors, who's been with us for 5 or 6 years, who at one point had 33 properties, just liquidated 13 in order to offset the cost of another investment where he lives. And then he's telling us that in 2022, he's coming back to start investing again. In his words, and I love this guy, he said the reason that he bought in Memphis had nothing to do with you or me. It had everything to do with the statistics.
Sure.
And he said the opportunity, especially back in 14, right, for him to get in with cash, buy either in 50% or 100% cash, or on his commercial line of credit that we got for him, to be able to just acquire real estate, was unmatched by any other city in America. And he measured us against places like Cedar Rapids, Iowa. I'm trying to think of a couple of others.
Little Rock, Arkansas was big for a while.
It was. And now it's
Nashville. I get a lot of questions about Nashville.
It's Little Rock is on one of Yahoo's top 10 lists for housing correction. So go back to full circle, back to our question of a housing bust, right? Basically, we don't see it. Listeners, we don't see it. We don't see it in the rental market.
Well, but I think we have to differentiate owner occupancy versus investment. Okay. The 2008 was an oddity. It'll probably never happen again as it did. It will get close, but it'll probably never happen like that again. But in Memphis, when you have, I think the latest stat I looked at was almost 49% of every resident inside the city limits of Memphis rents, doesn't own.
Yeah.
The latest statistic. When you have that kind of a renter base, the rental market's going to boom. It's going to continue to boom because there's always renters looking to rent a house. I've always got an investor wanting to buy a house or an investor trying to sell a house. So that's a constant. What happens in the investment market is people get too tied up in market value instead of rent comps. The only way the housing market on the rental side is going to take a collapse is if we have a massive recession and FedEx has to lay off 5,000 people, and Nike and Amazon, they're all starting to lay off distribution people. Yeah, now we're going to have a crisis. But as long as those companies stay whole and functioning, the owner-occupant market may have a shift, may have not a collapse, but a correction. But the rental market's going to stay steady, as it did through the collapse in 2008. The average state saw anywhere from 20 to 45% loss in property value. I think at its peak, Memphis is only, I think the highest point it hit was 16 or 17.
If we're talking about
the lowest in the nation.
An annual loss, like the highest.
The value loss of real estate that caused this collapse of the market.
I think over the entire from the top to the bottom. Okay. Right. So that would be from early 07,
08 to about 12
to about 12. I think that we saw we saw a loss commensurate with the rest of the nation, but it was on the lightest side of it.
Correct.
So yeah, I think 16% is about the maximum that we lost over the course of how many years is that? 4? Yeah. Now, that's tremendous.
The reason behind that, I believe, is that the renter base is so massive here that investment real estate kept the housing economy in Memphis from completely going over Niagara Falls as it did in California and Texas and a bunch of states that got really hit really hard. Tennessee got hit really hard, but Memphis as a city did not, even Shelby County did not see that massive crush. So what do you attribute that to? I attribute it to the fact that there's so many people that rent here that the rental market stayed hot, stayed solid. Values dropped. Guys got better deals on properties, but those properties recovered quickly. Why? Because they're cash flow properties. The market value was immaterial at that point.
Well, okay, so one of these days we're going to have to get into what inspires investors to invest. Mm-hmm. Okay.
Cash flow.
But yeah, right now. Right now, that's true, but we're in an atypical marketplace.
Used to 2008, it was equity. I could buy this for $100,000. It was worth $200 last year. It's going to be worth $200 again. Yeah, right. Equity. We have you have an investor I work for that that did that. They made a ton of money. Yeah, buying up properties pennies on a dollar.
We had one, in fact, if the listener wants to go back, I forget which episode it is, 7, 8, or 9, vera montez. Mm-hmm. We talked about him, controversial fellow, love him, right?
Yeah.
Made some decisions, great guy. He bought all of his properties on equity between, like you said, 2000 and 2005, I think is when he stopped. Because in 06, and this is why people liken this, this is why people say, oh, we're headed towards another housing crisis. Look, I'm not trying to make fun of you. But the point is, they say that where we are right now is similar to where we were in 06, right? Gas prices are going up, housing prices are at an all-time high. The difference is, what's the major difference with housing prices?
We did not lend the money to every person that had a pulse to buy a $300,000 house on a stated income loan.
So that's a government, that was a federally mandated requirement. Okay, so we have federally mandated requirements over here. Guess who picked up on that? It was the banks. If you look back at the interest rates in 06.
They were giving money away.
Well, but they were 6%. Mm-hmm. There were 6%. And then there were these weird variable rate loans where people would pay interest only at, 8%, 8.5%. We're not seeing that right now.
The pin in that grenade that finally pulled was in 2005 or 6 when they expanded the federal loan guarantee program, and it all started back with the Community Reinvestment Act. And then all of a sudden, I forget the senator's name, but he was on the banking Senate banking.
Dodd or Todd?
One of those clowns.
Yeah, he was Dodd.
Anyway, they were threatening banks because they weren't lending enough money to minorities, right? So what did Bank of America do and Citibank? Well, the government's going to guarantee it, so guess what? Here's a new non-stated no-income loan. You just say or stated income loan. I make $10,000 a month. Great. Here's a $300,000 mortgage. Go buy your house. So you took people with no financial skills, no money management skills. You tell them, I can give you a $300,000 loan. You can go buy this beautiful 5-bedroom house in Cordova and fill it with furniture. The first thing they're going to do is like, well, hell yeah. Okay. Well, the rate's 6.5%. I don't care. Bank of America doesn't care. Who's backing up the note? The taxpayers.
Yeah.
So if that homeowner collapse of defaults, and we had many that never paid a mortgage payment, when they default, Bank of America then takes that home, forecloses on it, sells it at auction. Then the U.S. government, Fannie Mae, Freddie Mac, then write a check to Bank of America to make them whole. And who walks away? Bank of America.
Right.
Meanwhile, the homeowner lost their house. The taxpayers sucked up the loss, and Bank of America walked away whole. And I'm not using Bank of America as an example.
Sure.
Picking on
We're
them.
Not calling them
all
out.
The banks did that. But the stated income loan, was that hinge pin they pulled that caused this domino effect. So the economy started sliding, gas prices up, we started getting into a recession. So what happened? People started getting laid off. Now they couldn't pay their mortgage. And when those people got laid off, couldn't pay their mortgage, then all of a sudden they began to realize, well, wait a minute, that person we laid off, they now can't pay his mortgage, probably should have never had a mortgage to begin with. For $300,000, they only make $30,000 a year. That was it. At that point, that snowball had started down the back of that hill, and there was no stopping it.
Well, then there's two other things that happened then that led to that. One is, I think the philosophy of home ownership was that it was cheap and easy, right? Like everything you just said, it led to the mentality of, it's easy to buy a house, right?
I mean, your application says, do you have a pulse? Yes. What's your blood type? A positive. Great, you're approved.
So when they lost that house that they couldn't afford, and that's the story we heard from everybody. Well, I mean, because you were in a completely different industry, we won't go there. We've been there. We're going to return there. But, the reality is that people said, okay, yeah, I got in over my head. I lost my house. Not a big deal. I'm going to rent for a couple of years and I'll go right back to it. What they didn't realize is what was coming. That tsunami of, changes in the federal government, changes in legislation about what a borrower was allowed to borrow, changes in the strength of banks, the closing of all of these banks.
And the strength of the buyer.
Well, but the strength of the buyer was never strong. It wasn't strong in 2006.
That's what I'm saying. That we're not going to see that kind of collapse because the requirements for a buyer today are way more. They're like they were back in the 80s. You really had to have some cash in the bank, a good credit score, a good job. There are some loans out there that allow you to get away with a lower down payment through FHA, but they're not just giving money away to people that should not be buying you can't afford a $300,000 house if you make $30,000 a year. The bank knows you can't, but the bank still gave you the money. So those days are gone. This crash that they're talking about, this dip, is all it's going to be. We're not going into that crash. If inflation hits and then we roll into a recession and costs keep going up, there are people around the country that are going to be laid off work, and there's going to be a housing crisis locally. But what you don't realize is in Memphis, this is a distribution city. Nike, Amazon, FedEx, all of these major worldwide distribution centers that are here are going to have to keep operating. So we're not going to see an unemployment issue or a crash here in Memphis. So if you have homes here, don't stress.
Yeah. So like we touched on this 15 minutes ago, how the labor market is going to be changing in places like Southern California, where they have more of an intellectual property marketplace. Right. They are producing and operating systems, and they can produce and operate the systems anywhere in the world. Mm-hmm. They don't have to live in Southern California anymore. Corporations are loosening up. They're actually saying, look, to go back to COVID, we're not going to make you vaccinate, but you're not coming into the office building.
Well, I mean, but one thing COVID taught most big companies is, like, if I'm a CEO of a company, I own a 20-story building to house 5,000 employees, and all of a sudden COVID hits and I have to scale down and run a skeleton crew and I put everybody at home with technology to work from home, and we figured out a system to monitor their work performance and what they're doing on an hourly basis, and we got all that figured out. The first thing I would say is, this building's gone. I don't need this building anymore. Right. Then the next step of that is for Bob, who's been working from home, tell his boss, say, you know what, I'm moving to Houston. I can work from home all day long. I'm just going to move to Houston. I'm tired of California. Sure. So I think California is in for a rude awakening in the next 5 to 7 years. I think that they have no clue what's coming. And what you're going to end up in California is you're going to end up with a bunch of Hollywood elites in their mansions cutting their own grass.
Well, and I see, here's what I see. Okay. I see in Southern California more of a stratification of incomes. Okay. So, there
is no middle class in California anymore. Very, very few spots have a middle class.
I could see from a hyperbolic standpoint how you would make that statement, but I do, like, I met with an investor Monday of last week that came in, and they would be middle class in California. They're considering relocation here because of the cost of living and because of the economic opportunities. In fact, he himself said a week ago, I could work from anywhere, right? I can work for my California company living here in Memphis. And so they're looking to liquidate their assets there, buy here not only their personal home, but also several other investments. And they already own maybe 5 properties that they bought at between $60,000 and $80,000, which have now already added between 20 and 30% increased value over the course of the last 18 months to 2 years. The point that I'm making is that they are definitely middle class. I see a stratification happening in California. I see the state, the red aspect, the conservative aspect of that state dwindling because they're moving away. So when they become removed from the population, what's left are people who are much more focused on, well how can we better organize the state? Instead of stay out of my business, the constituents of California are going to say, how do I join the California government in better organizing my direction? Obviously, what we're talking about is highly, highly controversial. I still think movies are going to be made out of LA. I think there's going to be an elite class like you're talking about. I think the movie industry is the most popular and profitable industry in the world as far as the amount of effort that you put into it and your return on that investment. So, you know, I think California is going to be fine. I just think it's going to shift in who's making the decisions. As far as Memphis is concerned, just going back to the, you know, for the listener, service-based economy, these are people that get up and probably do something outside of their homes for a living every day.
Sure.
And we all need that stuff. We all need it. You need it. I need it. And so we don't see there being a housing crash really at all in the country. We also don't see a major housing crash here in Memphis. That to us just seems absurd.
The worst crash in our recent history, we massed 16% loss over 4 years.
Right. And there are places.
If you're holding a property, if you'd have bought a property in 2005, lost 16% in 2008, by 2012, you'd gained another 5 to 6% over the 16 you'd already lost.
So 16% lost over the course of 4 years. And what just happened between August 2020 and end of July 2021, we increased values 17%.
Right.
So that's 1 year gain would have offset a 4 year loss.
Sure. And that's the key. Yeah. So just make sure that if you're focused on buying real estate, actually, if you want to focus on buying in Memphis, go to epmrealestate.com, go down to the bottom, look for me, Brett Bernard. My cell number's on there. You can give me a call anytime or shoot me a text. I'll be glad to talk to you and educate you on the Memphis market. That's a shameless plug from me, just to try to top Aaron's.
You know what? You're here, right? Like, you're here recording with me. Nobody else is. So, dude, you get the plug. It's all yours.
Yeah, if you're interested in the Memphis market, just give us a call. We'll fill you in on our opinions. But yeah, don't freak out. We're not coming for a crash. We're going to have a correction. That's all it's going to be. You'll see a dip. It'll come back. You'll be fine. You'll live to see another day. So.
Thank you for listening to Behind the Curtain Podcast, your real-world guide to real estate investment and property management. Be sure to subscribe at BehindTheCurtainPodcast.com. And if you'd like to learn more about Enterprise Property Management's real estate services, please visit us on the web at epmrealestate.com. This has been a Sound Ideas Group production for Enterprise Property Management, Inc.